Wall Street never saw this coming. The US financial market has seen it all: crashes, rallies, bubbles. But what's unfolding right now feels different. It's quiet, calculated. It was almost invisible at first. While all the headlines were focused on daily stock movements and short-term noise, something far bigger was taking shape just beneath the surface. And by the time Wall Street realized what was happening, it was already too late to stop it. Across the United States, institutional investors, hedge funds, and the real long-term players began reacting almost simultaneously. Charts started to shift in ways that didn't make immediate sense. Liquidity, the lifeblood of the market, began to tighten. Volatility, that old ghost, crept back into the system. And who felt it last? Retail investors. They always do. But here's the key. This wasn't caused by panic. This wasn't driven by hype. This was a deliberate, strategic move. So, what was the silent trigger that changed everything? Unlike the dramatic crashes of the past, this market shock didn't arrive with flashing red warning signs. There was no breaking news alert, no emergency announcement from the Fed. Instead, it all began with a very subtle shift in the flow of capital. Large financial institutions quietly started repositioning their assets. We're talking about billions of dollars moving out of high-risk positions and into safer havens. Liquidity just dried up in places where it once flowed freely. Bond yields reacted. Commodities responded. The dollar hesitated. To the average American investor, just checking their 401k, it looked like normal market noise. A little up, a little down. But to the professionals, the ones who manage the serious money, it looked like preparation. And that's a critical difference. Why does this move matter to every single American investor? Well, the US market isn't just a casino where stocks trade. It's the backbone of our retirement accounts, our pensions, our savings, and our long-term wealth. When the large players move first, the impact eventually trickles down and reaches everyone else. What made this moment so dangerous wasn't the speed of the drop. It was the silence that came before it. Historically, the most damaging market events happen when investors feel the most comfortable, when volatility seems totally under control, when fear is low and confidence is high. That's exactly where the US market was. And that brings us to market psychology, the calm before the storm. Investor psychology plays a much bigger role in the markets than numbers ever will. When markets stay calm for too long, risk builds up quietly, right under the surface. Traders get complacent. They take on more leverage. They start ignoring the warning signs. That is the precise moment when smart money exits. Right now, the US market is caught in a difficult spot, somewhere between denial and realization. Some investors believe this is just another temporary pullback, a buy the dip opportunity. But others, they sense that something structural is changing, something that won't be fixed with a quick rebound. This psychological divide is what makes the next phase so incredibly dangerous. Now, you might be thinking, were there any signals? The data signals everyone missed? Yes, there were signs. There always are if you know where to look. We saw unusual volume spikes happening at odd hours of the trading day. We saw capital rotating out of the popular high-flying growth stocks. We saw rising demand for defensive assets, things that hold their value in uncertain times. And we saw sudden strength in traditionally boring sectors of the market. Individually, each of these signals meant very little, but when you put them all together, they painted a clear picture. This was preparation, not panic. When professionals prepare, they don't send out a press release. They don't announce it on TV. They just act. So why was Wall Street caught off guard? It's because Wall Street relies heavily on its complex models, its forecasts, and historical patterns. But here's the thing. Markets don't repeat exactly. They evolve. This time, the shift wasn't driven by emotion. It was driven by pure strategy. Major players weren't reacting to bad news. They were acting before the news even broke. That's why all the traditional indicators failed. By the time the headlines start explaining what happened, the opportunity, or the damage, has already occurred. So what happens next in the US market? I see 3 possible paths forward, and all of them matter for your portfolio. First, volatility returns with a vengeance. Markets could enter a phase of sharp, unpredictable up and down movements. This kind of environment rewards experienced, disciplined traders, but it absolutely punishes emotional investors who buy high and sell low. Second, we could see a slow grind lower. Instead of a dramatic crash, the market could slowly bleed value over many months. In some ways, this is even more damaging because people stay invested too long, hoping for a recovery that never quite comes. It's like a slow leak in a tire. Third, a shock event. If an external trigger hits, like unexpected economic data, a geopolitical crisis, or a sudden policy change, the market could react violently and quickly. None of these scenarios favor unprepared investors. So how are smart investors positioning themselves right now? Across the USA, disciplined investors are doing 3 simple things. First, they're reducing unnecessary risk. They're trimming positions that have become too speculative. Second, they're increasing liquidity. They're holding more cash, ready to deploy it when the right opportunity appears. And third, they're watching, not chasing. They're not trying to predict the future to the exact day. They're preparing for multiple possible outcomes. This is the mindset that separates the survivors from the victims in every major market cycle. This isn't just another market story. This moment feels different because it's not emotional. It's calculated. The moves happening right now suggest a longer-term shift in how capital flows through the entire U.S. financial system. Whether that results in a massive opportunity or a significant loss for you depends entirely on your awareness and your timing. Remember, markets don't crash because of bad news. They crash because too many people are unprepared for that news. Here's the warning for retail investors. If you're watching the market right now and feeling confused, you're not alone. That confusion is a signal. It means the market is transitioning, and transitions are where wealth changes hands. The worst mistake you can make isn't selling too early or buying too late. The worst mistake is not paying attention at all. So my final thoughts are this. Stay ahead, not afraid. This isn't a call for panic, it's a call for awareness. The U.S. market is entering a phase where information matters more than emotion, where preparation will always beat prediction, and where patience outperforms impulse. Wall Street didn't see this coming, not because it was invisible, but because it was quiet. And in the world of finance, quiet moves are always the most powerful. Something feels off in the U.S. market, doesn't it? That feeling you have, that hesitation, it's real. And by the time Wall Street officially acknowledges it, the game has already changed. What began as a quiet shift is now showing up on the charts. For months, the big money, the institutional players, have been repositioning themselves. They've been reducing risk, increasing cash, and moving into defensive positions. It wasn't panic, it was preparation. And while they were preparing, most retail investors were still being told to buy the dip. Let's break down what's really happening. You see, the market didn't just collapse overnight, it tilted. And a slow, quiet tilt is often far more dangerous than a sudden crash. Why? Because it doesn't trigger our fear response. We keep holding on, hoping for a rebound, while our portfolios slowly bleed out. At first, the analysts on TV called it a healthy correction. They said it was just profit-taking or seasonal volatility. But then the patterns started breaking. Stocks that were supposed to bounce just didn't. Rallies felt weak and fizzled out. Suddenly, bad news actually mattered again. Across trading desks all over the country, professionals noticed the same thing at the same time. Buyers were gone. That hesitation, that lack of conviction, is the market's heartbeat slowing down. The biggest shift wasn't in the prices themselves, but in behavior. The smart money stopped chasing gains and started playing defense. They aren't predicting a crash. They're preparing for instability. And instability is where most retail investors get wiped out. This is why the market feels so heavy right now. Even on good news, it struggles to rise. Every small gain is met with a wave of selling. This is what happens when confidence erodes from the inside out. The market isn't panicking, it's questioning itself. And there's another problem nobody's talking about: liquidity. Think of liquidity as the oxygen for the market. When it's abundant, everything moves smoothly. But right now, it's tightening. It's becoming uneven. Some sectors are starved for capital, while others are hoarding it. This creates sharp, unpredictable swings in both directions. And emotional decisions in an unpredictable market are a recipe for disaster. This is the danger zone for the average investor. Retail investors almost always react late. Not because they're slow, but because the real information reaches them last. By the time the headlines finally explain what's happening, the institutions have already moved, they've adjusted their positions, and they've shifted the risk onto someone else. Many people are still asking, is this a dip to buy? But the smarter question is, what kind of market are we in now? While social media is busy debating price targets, the pros are watching three key signals. First, failed breakouts. When the market tries to push higher and fails repeatedly, it's a sign of exhaustion. Second, rising correlation. When completely different assets, like stocks and bonds, start moving together, it often signals a major shift is coming. And third, defensive rotation. Money doesn't flow into safe haven sectors like consumer staples and utilities by accident. It's a deliberate move to protect capital. These signals don't scream, but they whisper a powerful warning. This is why this current phase is more dangerous than a full-blown crash. A crash is obvious. A slow transition is not. During these quiet shifts, investors stay hopeful. The losses feel temporary. And we slowly increase our risk thinking we're getting a bargain. By the time real fear kicks in, the damage is already done. This is how wealth erodes, not with a bang, but in silence. So what is Wall Street actually doing right now behind the curtain of public optimism? Their internal risk models are tightening. Their exposure limits are being cut, and their hedging activity is increasing significantly. They aren't betting on a disaster. They're simply refusing to be vulnerable. That's a critical distinction. For the average American investor, the biggest threat right now isn't the market itself. It's emotion. Fear screams, sell everything. Greed yells, buy the dip. Both are emotional reactions. The disciplined approach is to observe, prepare, and stay flexible. This market will reward those who adapt, not those who try to predict. So, what does this all mean for the near future? No one has a crystal ball. But the message is clear. The easy money phase is over. From here on out, gains will be harder to come by, mistakes will cost more, and patience will be your most valuable asset. This is a market that tests discipline, not courage. Every major market shift has a moment just like this one, a quiet pause before things accelerate. Whether the next move is down, sideways, or violently volatile, one thing is certain. Unprepared investors will be the ones who pay the price. The US market is no longer forgiving, it's selective. And this is how capital changes hands from the uninformed to the informed. This isn't the end of the world. It's the midpoint of a new chapter. The quiet phase is ending. The real test is about to begin. The best thing you can do right now is stay sharp, stay liquid, and stay aware. Those who stay calm, informed, and flexible will not only survive, but may even find incredible opportunities. Those who ignore the signals won't see the damage until it's far too late. It started like any other trading day. Futures were flat, analysts sounded neutral, and the headlines were quiet. But underneath that calm surface, something was different. Something shifted early in the session, and it didn't look back. Right where you'd expect buyers to step in, there was only selling pressure. Key support levels that should have held crumbled faster than anyone expected. The bounces, when they came, were weak and died out almost immediately. By midday, any seasoned trader could feel it in their gut. This wasn't just noise, this was a change in character. You see, price tells you what happened. But behavior tells you why. What really sent a shock through Wall Street wasn't just how far the market fell, but how it fell. The dip buyers, who had been so reliable for so long, suddenly hesitated. The algorithms, which often prop up the market, flipped to a defensive stance. And the volume surged at critical levels, confirming the sellers were in complete control. This wasn't panic. Panic is chaotic and irrational. This was something colder, something more deliberate. This was acceptance. Acceptance that the old, familiar rhythm of the market was gone. For months, maybe even years, investors operated on a simple belief. Any dip was a buying opportunity, and any weakness would be temporary. That single belief was the engine that powered this market higher and higher. But markets don't run on belief forever. Eventually, they demand proof. When hope starts to fade, the underlying structure of the market takes over. And right now, the US market is trading on risk, not optimism. That changes everything. The moment the professionals saw this shift confirmed, their behavior changed instantly and decisively. Hedging activity, which had been quiet, suddenly exploded. Portfolio managers weren't just trimming their positions anymore, they were cutting their exposure significantly. And cash stopped being something you put to work and became a strategic position in itself. These moves don't make the front page of the news right away, but they are the tremors that signal the earthquake to come. Smart money doesn't wait for the headlines to tell them what to do. They move when uncertainty becomes the only certainty. So why did so many retail investors feel this move so late? It's not because they're careless or uninformed. It's because they're human. By the time the confirmation of a real market shift filters down to social media feeds and news alerts, the professionals have already repositioned. That gap, the delay between institutional reaction and retail realization, is where the biggest losses happen. It's a gap between preparation and reaction. And that brings us to where we are now, entering what I call the dangerous middle phase. This is the phase that most investors get completely wrong. It's not the euphoria of a bull market, and it's not the sheer panic of a crash. It's confusion. In this phase, the market swings wildly in both directions. Every rally feels like the real deal, like the all-clear signal has been given. And every sharp drop feels like a temporary pullback, just another dip to buy. This is the environment where portfolios don't blow up in a single day. They bleed out slowly, quietly, day after day. So, what does this mean for the next 90 days? As we look ahead, three powerful forces are now set to dominate the US market. First, volatility is back, but this isn't just random, choppy price action. We're talking about sharp, fast, directional moves that brutally punish anyone who hesitates. Second, liquidity is becoming highly selective. Money will still flow, but only to assets where confidence is high and the story is clear. Everything else, all the speculative plays and hopeful stories, will get ignored and left behind. And third, risk is being repriced across the board. For a long time, assets were valued on dreams and future potential. Now, they're being valued on something much more tangible: durability. Can this company survive a slowdown? Does it have a strong balance sheet? Does it generate real cash flow? This isn't an environment that rewards speed. It's an environment that rewards discipline. But the biggest battle ahead isn't technical. It's not about charts or indicators. It's psychological. It's the battle you fight inside your own head. The fear of missing out on a sudden rally, that FOMO, will push you to buy at the worst possible time. The fear of losing the gains you still have will push you to sell in a panic at the bottom. And the fear of being wrong will paralyze you, preventing you from making any decision at all. Remember this: markets don't destroy your capital. Your emotions do. Now, I want to be very clear. This isn't a message about the end of the world or some impending collapse. This is about a reset, a recalibration. The market is forcing everyone to reset their expectations, their tolerance for risk, and their very behavior as investors. This process is always uncomfortable, but it's absolutely necessary for a healthy market. Every major market cycle in history has this chapter. The investors who understand what's happening survive and even thrive. The ones who fight it, who cling to the old rules, don't. So what is the one mistake you absolutely must avoid right now? It's chasing certainty, because there is none. The goal isn't to perfectly predict the next 5% move up or down. That's a loser's game. The goal is to stay flexible enough to respond to whatever the market throws at you. This means focusing on liquidity, so you have the cash to act when an opportunity appears. It means staying aware, paying attention to the market's behavior, not just the headlines. And it means having patience, waiting for the high conviction setup instead of chasing every small move. These aren't boring strategies. In this environment, they are your survival tools. Let's wrap this up. The market has spoken. The period of quiet, steady gains is over. The market has chosen movement over hesitation, structure over hope, and reality over comfort. What happens next won't reward prediction, but it will handsomely reward preparation. This isn't a story about fear, it's a story about awareness. Because in every great market shift, wealth doesn't just disappear, it changes hands. And right now, it is moving again. Thank you for watching, and if you found this valuable, please consider subscribing for more insights.